So in this particular chapter, we'll be, going through the pricing strategies of businesses, different pricing strategies, and also understanding that what pricing strategies will be helpful for businesses. And tomorrow, when you will be joining an organization, how would you be helping organizations in setting their pricing strategies? This is what we will be doing in this particular session. All right. So now if you can see it at the front, you can say it is, said it right in front of you that we are going to see what are the factors that influence the pricing of a product. We are going to explain about the price elasticity of that demand. And there are many more things which are there in the introduction. Let's just jump into the main content of it. See, understand this. Pricing is, as they're putting it down in a more ABCD format, is nothing but your cost plus your profit is equals to your price. Now that's what it is said. Now cost plus profit is equals to price. That's understood everywhere. But the thing is, how are you going to price it? Are you going to price it based on this method only, or you're going to use any other method for it? How is that going to be? That's the bigger question in here. All right. So now let's get forward with it. Like different types of market structures, like a perfectly competitive market. First of all, perfectly competitive market is not even there. This is just an concept for explanation. Perfect competitive market is not at all there in existence. It says that everybody has the perfect information, everybody can maximize their profit, and all products are the same. That's not even there. That's a myth. Perfect competition is a myth that does not exist. Okay, now comes imperfect competition, which is actually there in the market. If you can see in here, that does not meet the conditions of perfect market. Now perfect market is not even there. Now monopoly, in which there is only one seller of a good. The seller dominates many buyers and can use its market power to set a profit maximizing price. Microsoft is usually considered a monopoly at that time. Now there are many more things also coming in. Oligopoly, in which few companies dominate the market and are interdependent. Firms must take into account likely reactions of rivals. If they are changing the price, then that is going to affect their businesses at large. For example, the Coca-Cola, Pepsi, and these kind of stuff which are there in competition regularly. Then monopolistic competition, in which products are similar but not identical. They are similar but not identical. There are many producers, price setters, and many consumers in a given market, but no business has total control over the market price. मतलब complete market के ऊपर there is no control on the market. They are not having control. These monopolistic competition, but they have their own price setting. They have their own different products. All right, there's a better example for monopolistic competition, and it is good for you to understand the differences between monopoly and monopolistic competition, because this can be a bit challenging in your examination if you don't have the clarity about all. Now, for example, if you see, there are many different brands of a soap on a market today. Each brand of soap is similar because it is designed to get the service which it wants, like clean it. Then, however, each soap product tries to differentiate itself from the competition to attract customers. One might say that you can have a soft skin with it. One might say that you can have a clean, fresh scent coming out of it. Each participant in this market structure has some control over pricing, which means it can alter selling price as long as consumers are still willing to buy its product at the new price. If one product costs twice as much as similar products on the market, chances are most consumers will avoid buying the most expensive product and will go towards the either quality or the price, whichever is good for them. The customer will go for that. Now, three broad based approaches which we are going to do. These three things we are going to do, and then pricing will be done. But these three things have a lot of scope to be covered in this particular chapter. Starting up with the demand based approach, you would be setting your price based on the demand of that product in that market, or that product or service in that market. Then you have cost-based approaches. It will be directly relevant towards the thing which I have just said at the start of the class. You'll have the cost of the product plus the profit, then you'll have your price, which is nothing but cost plus profit. That's your price. That's totally based on your cost. Then you have marketing based approaches. Now marketing based approaches, there are different stuffs which you would be coming through at times just to increase the sales. You would be willing to give away the profit margin and stuff because you'll be able to capture market. So those are different approaches which we are going to look into in detail in this particular chapter. Now, starting up with demand based approaches, the economist point of view, the relationship can be described by an inverse linear relationship. Now understand this: if the demand of the product is more, what will be the price of the product? Or suppose they are having a different issue. Suppose the price of the product is less, the demand of that product will happen. What will be it? It will be inverse. Price is low, quantity demanded will be high. Price is high, quantity demanded will be low. Now you can see this, that there are two methods of solution to problem: investigating the relationship between price and demand, the algebraic approach and the tabular format. Now if you see in here, the quantity, the price of the product is decreasing. The price of the product is decreasing as the quantity is increasing. Quantity is increasing, the price of the product is decreasing. Now understand this: you can have these two as one is dependent, one is independent, but most of the time this person is independent and then this goes on. But at sometimes you set the price also based on how many people actually want it. So it's a bit of complex thing, that understanding what the market is, understanding what is the price of the product, and then take up towards the quantity and stuff. Now let's just move forward from here. If you can just see in here, the marginal revenue is additional revenue from selling one extra unit. Now they had also this in this table. You can see here, as the price decreases, but there is one point at which there is they are going towards a loss, and that time they should stop. Now this loss, you're not talking about the in instance what's the losses. They are talking about what is your marginal cost to it. So this is the price, this is the place at which your profit is maximizing. Your marginal cost somewhere in between this, maybe 155 or something, that's the maximum profit point, optimum point, which you can say. The optimum point is $50 at the output less than quantity 3. The extra cost of making a unit is less than the extra revenue from selling it, so it is worth selling it. At output greater than quantity 3 is Q is equal to 3. The extra cost of making a unit exceed the revenue from selling it. This point they are talking about, that this is the place, as I just said, 155. So 155 yahan pe bhi to hai, the point at which they are maximizing the profit. Now, procedure for establishing the optimum price of the product. This is a general set of rules that can be applied to most questions involving algebra and pricing. Now understand this: establish a linear relationship between price and quantity demanded. What is the relationship between price and quantity demanded? That is to be understood, where A is the intercept, here the maximum theoretical price at which demand will fall to 0. B is the gradient of the line, here the amount the price has to change the demand by 1 unit. Now since the price of the product increases, the quantity demanded will decrease. See, price is increasing, quantity demanded will decrease. एक relationship, normal relationship between these two variables, and the demand increases when the price drops. The elasticity B has a negative value, but it is usual to ignore the minus sign. The equation of a straight line P is equals to A minus BQ can be used to show the demand for a product at a given price. Now look into this graph. They are just talking about the same linear relation, inverse linear relationship between price and the demand of the product. All right, and they've just said this at the double gradient to find the marginal revenue is nothing but MR is equals to A minus 2BQ. Establish the marginal cost, equate marginal cost and marginal revenue to find out what the quantity is where they are having the optimum price at most maximum profit. In short, this one which we just did, this one, like this is the point at which the maximum profit is. Afterwards they are going towards they are going down. Fine. Moving forward, the price elasticity of demand calculation. Now, the price elasticity of demand, we've already done it in management accounting, but still it is a more, extension of it. Now, price elasticity measures how responsive, who is responsive? Demand is responsive to a change in the price. The price elasticity of demand measures the proportional or percentage change in demand as a result of corresponding proportional or percentage change in price. Now, it can be calculated as follows. Price elasticity of demand is nothing but change in quantity demanded as a percentage of demand divided by change in price as a percentage of the price. Now, this is something which we have been doing since our intermediate days, this formula to be applied. Now, in management accounting also we did, and we are doing it in performance management also. It is just talking about that how much is the demand going to change when the price is going to have a change. If it is changing, it is elastic. If it is not changing, it is inelastic. All right, like 0.8 it is, so kind of elastic to 80% it is. If the demand change, it's kind of where it is interpretation of PED. If the percentage change in demand is greater than the percentage change in price, then price elasticity is greater than 1. All right, demand is elastic, very responsive. Okay, now understand this. Demand is elastic, that is very responsive to change. Total revenues increase when price is reduced. Total revenue decreases when price is increased. Okay, now moving forward, what is inelastic demand? Not very responsive. Not very responsive, does not change. Does not change. Sorry, does not change. If the price is changing, the demand remains the same. That's more of towards the necessary goods. All right. Now, moving forward, there's an additional example, but let us just move forward because it's almost the same which we've been doing since long time. Management accounting and the same question. Same goes with tested understanding 1 and 2. I would request you guys to solve these questions and get back to me. Tested understanding 1 and 2. And then we take it forward from there. Now moving forward, the tabular approach to price setting involves different prices and volume sales being presented in a table. When data in the exam is given in tabular form, there is no indication about the demand function or when there is no simple linear relationship between the output and profit. The tabular approach is likely to be the best to define optimum profit and associated selling price. Then it makes sense to calculate the profit for each price and quantity combination and finally select the price at which the level of profit is maximized. Right, I hope you guys are getting it. Now just read this particular question. I am just giving you a minute for it. So in this question, if you see, XYZ Limited is a car manufacturer introducing a new type of car in a market where there is imperfect competition, so that to sell more units of output, it must reduce the sales price of all the units it sells. The following data is available for prices and cost. Now you can see 50 per unit, price per unit. You can see as the demand is increasing. Okay, as the demand for outputs is increasing, the price per unit is decreasing and the total cost is increasing. In short, this is also quantity increasing. Complete the table below to determine the output level and the price at which the organization would maximize its profit. This is already there in management accounting, but still what we are doing is nothing but, as we have these particular thing, we are finding out what is the total revenue. Now total revenue is nothing but price into total demand. What is the marginal revenue is nothing but the extra income which you're going to get. The total cost is nothing but the units and multiplied by the total cost. The marginal cost is nothing but the extra cost at every each unit you produce. And then the profit is nothing but this total revenue and minus total cost is your profit. That's what it is. You need to fill it up now. But That's an easy thing which you guys can do. For now, I am moving forward. That's what it is, right? Same thing which I just said, that multiply both and get it. Now, moving forward, equation for the total cost function is nothing but y is equals to a plus bx. Now, this particular function is going to come in most of the times, where a is the fixed cost, b is the variable cost per unit, and x is the activity level, and y is the total cost, which you are going to find it out. Variable cost, fixed cost, activity level, you get your total cost, because fixed cost is fixed irrelevant of the activity level. Variable cost is proportional towards the activity level. All right, let's move forward. Suppose a cost has a cost equation of y is equals to a plus bx, which is nothing but 5,000 plus 10x. So 5,000 is your fixed cost, 10 is your variable cost per unit. This can be shown as follows. Now x, you need to find out what is the variable cost per unit. Now once you find out what's your variable cost per unit, okay, once you find out what's your variable cost, oh sorry, once you find out the level of activity, then you get it, because x is the level of activity, right? Yeah, is the level of activity. Once you get the level of activity, you get your total cost. Now fixed cost is 100,000, variable cost per unit 5 up to 1,000 units, volume of 1,000 units, receive 5% discount on all units. Derive the equation of the two cost function. Now is it this one? Yeah. Y is equals to a plus bx all okay. Now is the volume 1,000 units only or less than 1,000 units? That we need to find out. If the volume is 1,000 units, then it's just 5,000 plus 100,000, 100,000, 1,05,000 will be the answer. Now in this equation, consider the linear function y is equals to a plus bx. The answer to the following question: the line would cross y-axis at the point the gradient of the line is, the independent variable is, the dependent variable is. Now which one is independent, which one is dependent? Like the fixed cost is the independent variable, and it will also cross the line, means the this line y is equals to a plus bx will cross this 1488, which is nothing but the fixed cost. Then you see the gradient of the line will be where the independent variable is what, dependent variable is what. You can see the gradient of the line is 20, because this is the level of sorry, this is the variable cost per unit. Independent variable is x, level of activity, and the dependent variable is y. Now I said that dependent variable can be a, but no, a is not the dependent variable. Independent variable, independent variable is the level of activity. Based on that only things will happen, right? Now cost equations including volume based discounts, this is also there. Now there's an additional example. You are given the following cost data: fixed cost 250,000, variable cost is 6 per unit up to 5,000 units. 10% discount on all units purchased over and above 5,000. So you need to just give an answer of both the equations. If we just to frame it like 5,000 into 6 plus 250,000, this is one equation. And then 10% discount on this means that suppose my level of output is 6,000 units, 6,000 units into 6 will be less 10%. So it will be how much? 5.4. 5.4 into 6,000. That's how it would be. 5.4 into 6,000. Yeah, into 6,000 and multiplied it. Oh, sorry, added by 250,000. That will be fine. Yep, that's how the equation is created. 5.4x. They have just given that if it is less than or equal to 5,000, then it is this much. More than 5,000 is that much. Then increasing sales and productivity. When an opportunity to increase sales and production arises in a business, the key question is to Will the increased contribution less variable cost generated by increased sales exceed additional fixed cost that will be incurred as a result in the increased sales? Okay, if the answer is yes, the opportunity should normally be pursued. Now, an opportunity arises to increase sales by 10,000 units. Selling price of additional units is $10. Variable cost of additional units 6. Fixed cost will increase by $50,000. Should the opportunity be accepted? What do we need to see? What do we need to see? Will the increased contribution, sales less fixed cost generated by the increased sales exceed any additional fixed cost? Now, 10,000 into 4 is equals to how much? Now, sales minus variable cost $4 multiplied by the increase in sales. That's going to be $40,000. $40,000 you're going to increase in sales. But how much is the increase in fixed cost? $50,000. Will you accept the project? No, you will not accept the project. Moving forward. Same example. Now comes cost plus pricing. Now cost plus pricing. Many businesses adopt simple cost plus pricing techniques. Cost is equals to cost per unit plus chosen margin or markup. There is a difference between markup and a margin. Markup is a profit expressed as a percentage. Margin is a profit expressed as a percentage of the sales price. Markup is based on मतलब cost के ऊपर आप add कर रहे हैं. Profit margin is on sales price. Now in the examination, if it is not given, you guys need to understand this. You can understand it by these two terms, which is markup and margin. Markup रहता किसके ऊपर? Cost के ऊपर. Margin किसके ऊपर रहता? Margin will be on price. Okay. Which cost to use, actual or standard cost? The advantage of using standard cost is that prices can be set in advance and fixed for the period concerned. This makes marketing simpler and may attract customers who value knowing exactly how much they will pay. The main disadvantage is that if significant variances occur, then the price may have been set too low, and the loss ensues. Now, the main advantage of using actual cost is that a profit is guaranteed. Okay. However, there is one second. Yeah. However, there is less incentive for the supplier to control cost, as inefficiencies can be passed on to customers. Such a contract may discourage some customers from dealing with the firm concerned. Examples where actual costs are used include large military contracts, where cost overruns often become a matter of political debate. Tradesmen, example builders, and car repairs, where the markup is incorporated into hourly labor rate used by the garage. Now, marginal or full cost. The use of marginal cost is simpler, as there is no need for the absorption of fixed overheads and could be argued to be more consistent with the use of contribution in decision making. The main difficulty lies in setting an appropriate margin or markup, as this will need to ensure that fixed costs are covered. In practice, the danger is often that prices are set too low. Marginal costing is particularly useful in short term. If you want just short term profits and stuff, then marginal costing and full costing is fine. Otherwise, you need to take all the cost into consideration. All right. Now, understand this. Why are we doing this is nothing but to understand what should be the price of our product or services which we are going to offer. Now, in that, you also need to be taking in the relevant cost, which we have already done, taken up in detail in management accounting. The previous subject itself, we have done it. Moreover, we did also the revision of these topics at the first chapter itself, where we take into consideration what relevant costs are and how do we take it into consideration based on the decision which are there in front of us. Now, the use of relevant costing is only suitable for a one-off decision, since fixed cost may overcome relevant in the long run. There are problems estimating incremental cash flows. There is a conflict between accounting measures such as profit and this approach. As said earlier, when we do this cost plus pricing, we need to establish what our cost is first. Once we have a cost, then we can add a markup 20% of markup, that is equals to selling price is equals to 120 per unit. If suppose it is 20% on sales margin, then it is 125 sales per unit, but here markup 20%, 20% add kar rahe aap cost pe, that's it. Consider how realistic target profit is. This will depend upon accurate knowledge of cost, the selling price arrived at being one which customers are being prepared to pay, selling the planned volume of goods. Now, advantages and disadvantages of cost plus pricing. Now understand this, it is simpler to use, widely used and accepted. Justification of the price increases because of the cost is increasing. But the disadvantages, you will not have a better economic growth. You will not be finding out the optimum price. You will not be able to grow your business at a faster pace. You will not know your business in the long run. That will be a disadvantage in the cost plus pricing. There are pros, there are cons. That's up to you to accept it and go forward. Now there's a tested understanding, which I'm not going to do because is there anything which is typical in it? The question itself is broken down into 5 parts. So that will be more easier for you to answer itself. What is the full cost per unit of the product using ABC? What can be a better strategy based on pros and cons? Which of the following statements regarding a marginal cost plus pricing approach are correct? Simple questions only. The only thing is the question is looking big, but it is a bit small only. Very small actually. Then we come towards the third one, the customer-based pricing, the marketer's approach. Now, customer-based pricing reflects the customer's perceptions of the benefits they will enjoy from purchasing the product. Example, the convenience status. The product is priced to reflect these benefits. This approach has regard to cost, but reflects the belief that the greater understanding you have of your customer, the better placed you are to price the product. On a remote beach in a hot country, the offer of food and drink to tourists on the beach will be perceived by them as being of significant benefit, and they are likely to be prepared to pay a significant amount in excess of cost. Now, place, environment, that particular situation, and your offer matters a lot. Okay, that's more of consumer based or competition based pricing, market based pricing. What to be sold this day will be more profitable for us. That is to be done. Okay. Again, test your understanding, where you can explain all these 3 methods which we have discussed: cost-based pricing, customer-based pricing, and competition-based pricing. Okay. Now, different pricing strategies available in here are cost plus pricing. So we have heard it. Market skimming. Market skimming is kind of a price which you would charge high. You would charge a high price at the start, but by the time the market gets used to it, right, the price will automatically come down for it. So you know that this product is going to come in the market at a faster pace, but at the start, whichever comes, they make the more profit from it. That is market skimming. Then comes penetration pricing. Now, penetration pricing is towards understanding that you go in depth of that market, you try capturing that market. Now, how are you going to capture that market is based on selling them at a very low price, like Reliance Jio. When they came in the market, they offered everything for zero. And then now they are in the market, they are having the market share, huge market share. Now, complementary product pricing, like suppose you price a product one and the other product comes for free, you would try to go ahead and take it. Product line pricing, volume discounting, like suppose you buy in bulk, you'll get less at a less price. Price discrimination of different products will give you a lot of sales. Relevant cost pricing, like whatever the cost is incurred, you try covering that up. That's how you would be also understanding it. That in fact, these are only the things which they are going to explain it further in detail. If you just see in here, skimming pricing, high prices when product comes first launched. Condition suitable, new and different. When Corona came in, prices of masks and sanitizers were shot up. Okay, but right now they are available at a normal price. Okay, then you see penetration pricing, charging of low prices at start and then later on increasing the price of the product. Then complementary product pricing is nothing but 1+1. Example, razors and razor blades. Razors are sold at a, if sales of razors increase, more razor blades will also be bought. As simple as that. Then product line pricing strategy, cost differences between the product, customer evaluations of different features. जैसे प्रोडक्ट लाइन के अंदर आप आईफोन खरीदते तो फिर वही इकोसिस्टम में you'll purchase iPad, iWatch and what all I you'll be able to do that product line के अंदर ही. Volume discounting, you buying bulk and getting discounts out of it. You will be able to sell more. Conditions suitable for volume discounting pricing strategy is more of, okay, you will get more of discounts because you're buying more products. That's it. Then again, different pricing strategies, situations they have put in, which you guys can do it. In fact, it's a very good for you guys to read this homework के अंदर लिख लो आप ये. This is definitely worth a read from you guys. Price discrimination and pricing strategy is understanding that when and where you need to set your prices and how you need to change those prices at times. Very important for you to do that, because if you don't discriminate it, if you don't change it by time, then you will be static and not having static and you will not be having growth at all. Dangers of price discrimination as a strategy. The black market may develop, allowing those in a lower priced segment to resell those in a higher priced segment. Competitors join the market and undercut the firm's prices. Customers in the higher priced brackets look for alternatives and demand becomes more elastic over time. Then we are actually almost done with the chapter. We are having testy understandings now, I guess so. Yeah, we are done with this chapter. More of a theoretical based chapter to understand these stuff. We have not yet made pricing strategies of products, but we have understood that how we make pricing strategies in a theoretical format. As the chapters goes on, we'll be increasing more of the details of it. Moreover, we are done with half of the syllabus, and in tomorrow's session, 13th November, we will be getting started with the next chapter, which is I guess limiting factors. So we have done. Then what? Relevant costing is there. Relevant costing is there. Make versus buy decisions and stuff. Pretty important chapter. We can expect a lot of problems out of from this also. So I look forward for you guys in the next session tomorrow as the time is mentioned in the group. All right.